Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Thursday. We're coming very close to the end of this week, and most importantly, the end of June month end as well as Q2 quarter end. Very good morning. Today will be Thursday, the 27th of June 2024. So before we jump straight into our daily dose of market insights, the detail and the gist of it for today's stuff, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposit. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so now before we jump straight into the short-term intraday technical outlook on the key cross-asset classes ranging from the major US dollar pair, the major stock indices, as well as two key commodities that we tend to cover almost on a daily basis, which is gold XAU/USD and West Texas crude oil. Let's have a recap yesterday in terms of the release of respective key news flow event and how their action or their release of this news flow impact the respective key cross asset classes. So the key thing that took shape yesterday was primarily focusing more on the FX market. So what we could see over here is that we do have a slew of this headline coming in that the dollar yen or the yen slides to 1986 low against the dollar. So if you look back over here, it's close to a 38-year low. All right, so they actually broke above the 160 handle per USD. So that actually doesn't come very close to our big surprise. Why? Because we do highlight at the start of this week daily dose of market insights that on a very short-term basis, the dollar yen still remains positive to actually evolve or oscillate within this short-term minor bullish trend. So later I'll touch on the this particular dollar yen pair, especially right now we start to see a very extreme negative headline against the yen. And also do not forget, because of the yen that is sliding to a low, that actually pretty much detrimental to the respective much more, I would say, that currency that are related to exports, especially the Chinese yuan, which also plunges as well, that actually have a negative feedback loop on the Hang Seng index. So still recall that on the Hang Seng index or the Hong Kong 33, we are still bearish in the short term from a technical analysis perspective. Why? Because it still trade below the 20-day moving average. So yesterday's negative news flow indirectly on the yen has a knock-on effect on the Chinese yuan as well, which also plunges. So let me share with you the chart of the Chinese yuan. Okay, so this is the Chinese yuan over here. Okay, let me expand my screen. Okay, so your Chinese yuan also hit a low against the dollar. So the dollar Chinese yuan also accelerate on the upside, but at a slower pace because it's being controlled by the Bank of China. So, but the Bank of China can't actually reverse the ongoing slide in the Chinese yuan. Why? Because of the dollar yen that is still weakening at this juncture. So since the bullish breakout of the 7.2270, this is the dollar versus the offshore Chinese yuan, the CNH. So with this break of the 7.2770, ever since last Friday, the related Chinese stock indices, that means i.e. the Hang Seng index, can't break above their 20-day moving average. So those who follow very closely in my daily dose of market insight, you guys should know what I mean. Later I'll flash the Chinese we call it Hang Seng index chart again. So very quickly, right, if you look at my screen over here, we see a slew of redness on the Hang Seng indices. The Hang Seng index is down negative 1.85%. The HSCEI, the H shares, that means the A shares that is kind of pseudo listed in the Hong Kong Stock Exchange, the HSCI also down negative 1.96%, almost 2%. The higher beta Hang Seng Tech Index, which is the China big tech stocks, down negative 2%, and with the CSI 300 is also down negative 0.7%, a bit at a slower pace of negativeness. All right. So net overall, that particular adverse negative feedback loop effect is still prevailing in the Hang Seng indices and the China stock market, indirectly due to a weaker Japanese yen, having a knock-on effect on the Chinese yuan, which is the CNH. Why? Because the Chinese economic growth right now is still centered on the external demand side of the story. That means in order for the Chinese economy to actually sustain a growth target of 5%, they need to rely on the external economy rather than domestic demand. Why? Because domestic demand is still lackluster because of a very weak housing market in China. So the only way to sustain external demand, if the Japanese yuan weaken, the Chinese yuan got to weaken as well. So that has a negative feedback loop into the Chinese stock market. All right. So this is a very I call it the dynamic linkage from there. Now, with that, another news flow I want to highlight yesterday was there's this very interesting revival of inflation rate in the globally. All right. So what you see yesterday, early during the Asia session, we do see this particular release of, okay, where was it? Pardon me. Give me a minute. Wednesday. Yeah, over here. Okay, we do see the monthly CPI indicator from the Australia side of the economy starts to actually be much more hotter than expected, 4%, and that actually surpassed 3.6% from April and way above expectation of 3.8%. So that actually is kind of indicate to us that there could be a risk of inflation resurgence in Australia if we start to see that Australia economy getting red hot. That means, i.e., Australia itself is not a closed door economy. That means it could start to spread out towards the other global economy as well. Something to bear in mind, but bear in mind for because of this better. So this is a repeat of where I just stressed yesterday. And also on top of that, what we could see over here is that yesterday we do have a weekly crude oil change, the weekly crude oil supply chain. So it's more of a short-term, we call it economic indicator that impact the oil markets. So what you could see over here is that this EIA crude oil stock change. So market is actually expecting a decline in supply to negative 3 million, all right, way below the previous week of negative 2.55 million per barrel, all right. But instead, there's an increase in the crude oil supply in US to positive 3.59 million. All right. So with an increase of crude oil supply in US, that actually kind of put on a cap in the short term for price increases in the WTI crude oil price. So if you look at WTI crude oil price, yesterday did a sell-off below our key short-term pivotal resistance at around the $82 per barrel. So later I'll touch more on that on the short-term technical outlook, okay, on WTI crude oil price. So this particular short-term we call it data out from the EIA crude oil supply, we call it a weekly change. So it's being compiled by the US energy agency. Every week they'll release this weekly supply of crude oil, whether US is accumulating crude oil stockpile or reducing the stockpile. So last week they actually increased their stockpile to 3.59 billion per million barrel, way above what market is expecting. So market is expecting a decrease in stockpile instead of negative 3 million. So that also explained to us why, at least in the short term, the WTI crude oil price that has rallied in the last 3 or 4 weeks, hesitant to break above that $82 short-term key pivotal resistance yesterday due to an increase in the supply of crude that's been accumulated in US. All right. has been reported by the EIA agency. So that is the two key data to actually take note of yesterday. And now let us take a very quick look at the performance of the major US stock indices. So the performance of the major US stock indices managed to did a minor bullish reversal yesterday upon the second half of the US session. So what we could see over here is that it was weak at the start of the US session, but throughout the second half of the US session, the S&P managed to inch up a slight gain of positive 0.16%, and the Nasdaq 100 very similar price movement as well. All right, and the Dow Jones, even though unchanged, it managed to actually see ease off in the earlier sell-off at the start of the US session and traded higher throughout the remaining part of the US session yesterday. So overall, what we could see over here is that a rather positive intraday movement among the major US stock indices. The Russell 2000 was the outlier. It underperformed negative 0.21%. And what we could see very interestingly over here, if you look at the heat map of the S&P 500, yesterday's recovery was actually being led by the mega cap stocks. All right, so Amazon has a very strong rally to negative positive 3.9%. The Apple as well, positive 2%. All right, they're not too bad on Nvidia. At least it managed to maintain a slight positive momentum after that intraday bullish reversal on Tuesday. What we see on Wednesday is a positive 0.25% overall. Okay, so something very interesting is that the mega cap stock is still providing leadership towards yesterday's intraday bullish reversal that is being seen on the three key US stock indices. That means, i.e., the S&P, the Nasdaq, as well as the Dow Jones Industrial Average. All right. So with that, now let us now very quickly take a quick look at the short-term intraday technical outlook for today, starting with the FX market first. So before we jump to the FX market, right, let us take a look at the intermarket dynamics. All right, on the FX market. So on the FX market over here, if we were to look at the current situation on the dollar index, okay, 1 second. Okay, so the dollar index right now is now fast approaching the upper limit of the short-term sideways range configuration that I highlighted earlier on. Okay, at this 106.37 over here, followed by the lower limit is at 104.90. Okay, this two range. Okay, what is 106.37? So 106.37 on the dollar index is in fact the descending trend line since 4th of October last year, and 104.93 is this 50-day, very close to the 50-day and the 20-day moving average that is acting as a support level. Okay, let me remove this. Okay, so what we could see over here is that the dollar index is now fast approaching this upper limit of this range that we highlighted earlier on, and there is right now as we are speaking, there's some signs of we call it put away that some signs of profit taking from yesterday's push up in dollar strength, as depicted by this black intraday daily candle that is playing out right now. And if we were to go to the 10-year treasury yield, the bond, okay, so the 10-year treasury yield also yesterday's push up has now come close to the 20-day moving average and the 200-day moving average over here. Okay, so what we could see over here is that it's now coming very close to a resistance level. Okay, let me put it in you guys to see. Okay, why is not showing? Okay, all right, seems to me that this thing is getting very slow as well every time when I kickstart this go to webinar. Yeah. Okay, at this level 4.34%, okay, right below the resistance. And if you look at the 2-year treasury bond, the 2-year yield treasury bond, this is the yield, is also hovering right exactly at the 20-day moving average that is acting as a resistance. So if you look at the 2-year treasury yield, that is much more in line with the US Federal Reserve monetary policy. It's continued to trade sideways. Okay, so there is no clear signs of what I call very strong bullish reversal on the 2-year and as well as the 10-year treasury yield that is still hovering below their respective resistance. So given that the yield do has a indirect correlation with the dollar index, that means i.e. we do have a yield that US 10-year treasury yield, the US 2-year treasury yield still be remaining below key respective moving averages resistance, that could potentially put a cap on dollar strength. So that's why it explained to us the dollar index in terms of the correlation. Okay, now this thing is getting cranky again now. Let me go back. Okay, because I don't know why it just flip everything to the treasury yield. Okay, so now that's why explain to us the dollar index. There's a intraday kind of profit taking candlestick right now that is showing right below the 1.0637 resistance that we highlighted earlier on the dollar index. Okay, so now why is it still being supported by the rising 20-day moving average, which is at 1490 level? So that means in the short term, right, we do expect a bit of sideways movement because the dollar is still being viewed as a safe haven asset in terms of geopolitical risk premium. So if you look at the current situation over here, we know that there is this upcoming uh, French localized parliamentary election. That is the first round that's going to be held over the weekend, which is this coming Sunday. So markets still view this as a potential geopolitical risk event. Why? Because there's a high chance that the France far right party will gain a significant foothold in the France parliament. So if that situation were to occur, there's a big, because that's only the first round of the election, so we do have a second round as well. All right, so we need to have the second round election, which is going to help the follow in July instead of the first week of July, the weekend, the Sunday, before determine the final outcome of the France parliament. Okay, so given that the first round right now is skewed towards the France party, the National Rally Party, which is the far right party that doesn't advocate we call it discipline in terms of the fiscal spending, that actually increases the credit risk of holding France long-term bond. So the credit risk of the France long-term bond is being inherent in the spread between the 10-year France sovereign bond yield versus the 10-year German sovereign bond yield. So what we could see over here is still holding above that major bullish breakout level that took shape last 2 weeks ago at around the 0.62%. So even though if you look at it from a daily chart perspective, right, over here, it's now also trying to do a inch up higher. All right, so this seems to us that it's trying to turn up higher, right, to trade much higher ahead of the first France parliamentary election outcome, the first round of the results that are going to be due on Sunday. Because Sunday will be the first round of the election, then the outcome rightly will be on Sunday as well. So that's actually explain an increase in geopolitical risk premium out from Eurozone that is also potentially translating for the dollar index to remain supported above its 20-day moving average. So going forward, we do expect a much more sideways movement of the dollar. It's only that right now the dollar index is approaching the upper limit of the sideways range that we highlighted. Okay, back to the dollar index again over here, 106.37. So going forward, at least in the short-term basis, there could be a bit of mean reversion again back down towards the lower limit of this 104.93 support level, which is the 20-day and the 50-day moving average on the dollar index. All right, so with that, now let us immediately jump straight into the short-term intraday technical outlook and the levels for us to highlight. All right, so before we do that, let me expand my screen so that you guys could see much better. Okay, so let us start with the euro dollar first. Okay, so the euro dollar over here, what we could do over here, it seems to us that it's now being trapped over here, the euro dollar. So this euro dollar yesterday, it plunges. Okay, it plunges because right now it's trading below the 20-day the 200-day moving average and as well the 50-day moving average. But what we could see very interesting over here, it plunges below and retests the lower limit of this symmetrical triangle range configuration that has a support level coming in at 1.056. So with that, right, yesterday we do wants to actually maintain a bullish bias, looking for it to retest back above 1.075, but it didn't happen. It plunged right below, but it didn't break below 1.0656. So what's this 1.0656? It's actually this gray line here. You can see this gray line, but this is the hourly chart. So if I were to flip to a daily time frame, okay, so this is the lower limit of this symmetrical triangle range configuration that is still playing out since the high of 18th of July and the low of 3rd of October. Okay, over here. So the euro dollar is something like a mirror image of the dollar index. Okay, if you could recall, I shared the chart earlier on. And given that it's now very close to the lower limit of this 1.056 level, okay, I don't see there is a big risk that it could break below 1.056, at least from a short-term intraday basis. Why? Because the US 10-year Treasury yield is now back to some resistance level. And also, if you were to look at from a short-term perspective for the euro dollar momentum condition, it managed to bounce off from the oversold level. And right now, if you look at the resistance level, if I draw a trend line, okay, it's now breaking above. Okay, it's very slow. I don't know why. Pardon me. Give me a minute. Come on. Okay, good. Okay, let me change this color to green. Okay, it's breaking above this former descending trend line resistance. Okay, so indicating to us that there is no clear sign of a bearish momentum follow through at this juncture. Okay, so that actually explained to me that I have no confidence that the 1.056 symmetrical triangle support level may be broken down to the downside. So with that, right, I would rather have a neutrality stance on the euro dollar for today, at least on a intraday basis first. So neutral between 1.0656 and 1.0720. Okay, over here, only an hourly close above 1.0720 may see a potential, we call it short-term intraday recovery to test the next near-term resistance at 1.050, then thereafter followed by 1.0770/1.0790, which confluence with the bunch of moving averages that is acting as a resistance as well, the 50, the 200-day, and the 20-day moving average, all acting as a confluencing at this 1.770/1.0790 level. Okay, only a breakdown below 1.0656, then that would actually see a very pronounced dollar strength coming back into the FX market to, at least in the near term, expose the next support level on the euro dollar at 1.62/1.06 figure level. Okay, so that's for the euro dollar. Moving on will be the sterling dollar. So the sterling dollar managed to be still maintain that 1.262, 1.26 level, the short-term pivotal resistance support level that we highlighted, and also still trading above the 200-day moving average. Okay, why is it so slow? Okay, because not sure why the trading view keeps hanging. Okay, so right now, what is this level over here? 1.262, 1.26 figure level is in fact the former minor swing high of 3rd of May. Okay, let me highlight to you. Okay, let me remove this FIBO extension. Okay, this level here. And if I were to do the FIBO retracement, okay, from the swing low of 9th of May all the way up to the high 3rd of May, it corresponds to the golden ratio as well, the 61.8%. Okay, so net no change, still using that 1.2620/1.26 figure level. Okay, as prices managed to hold above this short-term pivotal support level that we highlighted earlier on. And what's interesting over here is that upon the test of this 1.2620, 1.26 figure level, the hourly RSI managed to hit the oversold region and shape a bullish divergence yesterday. So indicating to us that some signs of bullish momentum condition reviving back into the sterling dollar on the appearance of this bullish divergence that I highlighted. So with that, as long as 1.2620/1.26 figure level, that's the access for today, holds, we will still maintain that short-term intraday bullish bias on the sterling dollar. First near-term resistance to watch is 1.2650. A breakout above it potentially sees a retest on this Tuesday minor swing high at 1.27 figure level. Only hourly close below 1.26 figure level will invalidate today's short-term intraday bullish bias to see a slide to retest the 200-day moving average. That's acting as a support level as well at 1.2565, which is this congestion area here, 7th of May and 14th of May. Below 1.2565 sees a further deeper slide to expose the next support area or support level in the short term at 1.2515 level. Okay, so that's for the sterling dollar. Okay, moving on, next will be the dollar major pair against the Asia Pacific currency. Let us start with the dollar yen first. So the dollar yen, before we go on the short-term intraday outlook, I want to share with you all the daily chart first, because why the daily chart is pretty important, because it gives us a bigger picture. So the current rally, right, so far that we see, it has been moving up very steadily since the close above the 20-day moving average, a retest of it on the 12th of June, and it's been trading up steadily. And right now, it already hit the upper limit of this major ascending channel that I drew from the low of 16th of Jan 2023, right? Hit this channel, and upon hitting this channel, I want to share with you all the volatility movement of this up move here. Okay, you can see my mouse by looking at the Bollinger Band. Okay, notice that the Bollinger Band also has a sharp uptick since 17th of June, right? This rising Bollinger Band. So a rising Bollinger Band indicating to us that the upside volatility has increases, and the upside volatility increases now corresponding to a test on the upper limit of this major ascending channel. So what it means that it actually increases the odds of a mean reversion pullback to retest close to the 20-day moving average again. Okay, so there's a increase in risk of such scenario taking shape. And now let us now skew down towards the lower time frame. And still, we call the lower time frame. Yesterday, we do highlight 16110 is my second resistance level above the 160.40 level. Okay, that was the previous minor swing high area over here. Okay, so right now the resistance level has really been met at almost been met at 1.6110 level, and given the rising upside volatility on the daily chart as expressed by the rising Bollinger bandwidth, increasing the risk of a mean reversion decline scenario to unfold in the dollar yen. And also on the hourly time frame right now, the hourly RSI has hit the extreme overbought level. So this level of our RSI is much more higher, slightly higher than the previous extreme overbought on 21st of June. Okay, so if you could look at the level over here, okay, where is the level? Okay, let me push it. Okay, on the 21st of June, it was at 85.64. Yesterday's level, okay, you could see it was 86.23. Okay, slightly above the previous extreme overbought level, and right now it has already exit from the overbought level. So indicating to us that right now the swift movement of the dollar yen, there could be a chance of evolving or kind of doing away from its previous extreme overbought level, that also increase the risk of at least a minor mean reversion decline on the intraday basis for today. So with that, right, I will actually flip to a short-term intraday bearish bias on the dollar yen for today using 16110 as my short-term pivotal resistance level. Why? Because of the elements that I explained to you or highlighted earlier on the daily time frame, and as well as this exit from the extreme overbought level on the hourly RSI. Next short-term support level to watch for that potential minor intraday mean reversion decline to work out 159.90. A break below 159.90 exposes this Monday bullish reversal level at 159.10. Okay, so these are the two near-term support level to watch out for today for this potential mean reversion decline scenario. Only hourly close above 16110 will invalidate today's intraday bearish bias to see the continuation of the bullish impulsive up move sequence on the dollar yen to expose the next near-term resistance at 16180, then thereafter followed by 16240 on the dollar yen. Aussie dollar, no change, managed to shape a bounce right at the 0.6640 short-term pivotal resistance that we highlighted as well, and also where it bounced off from the 20-day moving average, and also the RSI also remains well supported as well by this ascending trend line. So still no change, 6640 short-term pivotal support to watch to maintain this short-term intraday bullish bias towards the upper limit of the symmetrical triangle range configuration. A breakout above 6670 may expose 6710 next. Only hourly close below 6640 will invalidate today's intraday bullish bias on the Aussie dollar to expose the next near-term support at 6610 in the first step, which is the 50-day moving average also acting as a resistance. A breakdown below 6610 may start to see floating down towards the lower limit of that symmetrical triangle medium-term range configuration, which is the near-term first step. The next near-term support level to watch will be 6590/6580, which is the minor swing low of 17th of June and 10th of June. Okay, so that pretty much sum up for today's short-term intraday technical outlook on the FX market. So if you look at across the board right now on the dollar, the $4 major pair that I highlight to you, there could be a risk of a dollar strength setback for today, at least on the intraday basis. Now, moving on will be the major stock indices. Let us start with the Asia Pacific indices first, starting from the Nikkei 225 or the Japan 225. So the Japan 225 yesterday did a bullish breakout, and we do highlight to maintain that bullish bias for that bullish breakout will be at 39,230 short-term pivotal support. So this level managed to help right now in today's Asia session after that intraday sell-off that took shape during the European session and throughout the US session. So no change, still using 39,230 as my short-term pivotal support level. Maintain short-term bullish intraday bias on the Japan 225, Nikkei 225. The first resistance level to watch for today, I will have a slightly higher tighter level over here. Okay, this pullback level. Okay, at 39,440, above 39,440 exposes the next near-term resistance level at 39,880 level. So 39,880 is in fact this congestion area here, the 4th of April and as well as 12th of April. Only an hourly close below 39,230 will invalidate today's intraday bullish bias to see the extension of this corrective pullback to retest the 20-day moving average acting as a support area or level at 38,750. Below it exposes the 50-day moving average, which acts as a next support layer at 38,460. So that's for the Nikkei 225, i.e. Japan 225. Now moving on to will be the Hang Seng Index or the Hong Kong 33. So the Hong Kong 33 still continues to remain weak over here. So yesterday we are looking for the first support level to come in at 17,780. So right now it already broke down below 17,780 and also seems to us will be breaking below this. Okay, it's this magnet that's doing. Okay. Okay, that is so-called symmetrical triangle range breakdown as well that is taking shape right now as we are speaking. So no change over here except that I have a tighter key short-term pivotal resistance level to maintain this ongoing short-term intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. So using yesterday's high, which is at 18,180, that also confluence with the 20-day moving average that's sloping downwards and the 50-day moving average as well, very slightly. So given the fact that right now the hourly RSI is already hit the oversold level, that could be a minor bounce first to take shape before further weakness to unfold in the Hong Kong 33. So where is this potential minor bounce? So this minor bounce could actually take shape at this level here. Okay, this is the resistance level to watch. Okay, let me put the magnet on again. Okay, gosh, it's very slow. Okay, this minor swing low area broke down, turns into a pullback support slightly above the pullback of this symmetrical triangle range resistance, now turns into a pullback support area as well at 17,940 level. So this is the first resistance, but I don't put it so tight because we do have other elements, that is much more elements confluencing at the 18,180 level. So this is the first resistance to watch for that potential minor snapback rebound. As long as this snapback rebound didn't surpass 18,180, we'll still maintain that short-term intraday bearish bias on the Hong Kong 33, with the next near-term support to watch will be at 17,600 level, the minor swing low of 2nd of April, as well as the next support level will be at 17,460 level, which is also the golden ratio of the previous rally from 19th of April all the way up to 17th of May, the 61.8 Fibo retracement level coming in at 17,460. Now, only a breakout above 18,180 will negate or invalidate today's short-term intraday bearish bias on Hong Kong 33, i.e. the Hang Seng Index, to see a recovery towards the next near-term resistance at 18,450, followed by 18,730 next. Okay, now moving on will be the European stock index, which is the German DAX or the German 30. So the German 30 over here yesterday managed to actually shape that negative reaction of our short-term pivotal resistance at 18,380, tested the first support area at around 18,100 before shaping a bounce back again during the US session. So still no change, still using, for sure, this is very clear pivotal resistance that preventing the boost from breaking out this week so far. So still using 18,380, which is so confluencing with the 20-day moving average and the 50-day moving average as well, that is acting as a resistance, giving it a very significant pivotal level to watch out for. 18,380 short-term pivotal resistance remains for today to maintain our short-term intraday bearish bias on the German DAX or the German 30. First support level to watch will be at 18,085, which is yesterday's minor swing low. A breakdown below it potentially revisit 14th of June swing low area at 17,990/17,930 in the short-term intraday basis. Only hourly close above 18,380 will invalidate today's bullish bias to see a deeper corrective mean reversion rebound to expose the next near-term resistance at 18,520, which also correspond to the descending trend line that I drew from the all-time high area from 16th of May. Above 18,520, then we could start to see a much more substantial recovery, at least in the short term, to expose the next near-term resistance at 18,640/18,685 next. So that's for the German DAX. Now moving on will be the US Wall Street Index. So the US Wall Street Index, the Dow Jones Industrial Average, yesterday's came down, play around with the pivotal support before bouncing up throughout the later part of the US session, and right now during the Asia session it sell off again. But what's interesting over here is that yesterday, even though it shaped a lower low, it managed to hold above the 50-day and the 20-day moving average that are both of them are rising at this point in time. So still indicating to us that is this particular short-term uptrend that is still intact, okay, since the low of 30th of May. And what's interesting over here is that yesterday test on the pivotal support, the RSI managed to shape a bullish divergence, okay, over here. Okay, indicating to us that the bearish momentum, yesterday bearish momentum seems to be losing strength as well. So what I do is that I would have a bit of excess of yesterday pivotal support level, 39,090/38,945, which is this minor swing high area over here, former minor swing area of 18th of June and 20th of June, and so coming very close to the 20-day and the 50-day moving average as well. And if you do the Fibo retracement of the push up from 14th of June last Friday to this Monday swing high, it kind of correspond to the 50% Fibo retracement. Okay, so as long as this 38,945 short-term pivotal support holds, the access hold for today, still maintain that short-term bullish bias for a potential recovery on the US Wall Street 30, i.e. the Dow Jones Industrial Average. First resistance to watch in the near term on the intraday basis, very close to yesterday's minor swing high at 39,290 level. Okay, this former congestion area here. Above it sees a retest to this Monday swing high at 39,600. Only hourly close below 38,945 will jeopardize today's intraday bullish bias to see a further extension of this minor corrective decline to expose the next support area at support level at 38,730. A breakdown below it sees a retest of this ascending trend line support area, ascending trend line from the low of 31st of May, also confluencing with this next support zone at 38,560 / 38,420 next. Now, moving on will be the NASDAQ 100. So what's next on the NASDAQ 100? So NASDAQ 100 managed to held above the short-term pivotal support level that we highlighted yesterday, 19,480, hit the first resistance during the European session, then thereafter it traded sideways. Right, so no change, still using 19,480 short-term pivotal support level, maintain that short-term bullish bias on the NASDAQ 100. First resistance to watch 19,840, a breakout above it potentially sees 19,990 next on a short-term intraday basis. Only hourly close below 19,480 will invalidate today's bullish bias to see the continuation of this minor corrective pullback towards the next support area at 19,240. Below it exposes 18,950, which is the minor swing low of 7 on June and 10 of June, and as well as this medium-term ascending trend line that I drew from the low of 19th of April. Okay, so that's pretty much sum up the short-term intraday technical outlook on the major stock indices. So what we could see is a mixed bag environment for now on the intraday basis. Commodities, let us start with the gold XAU / USD. So I see gold over here. This is the daily chart of gold, pretty much bearish. Why? Because price action continues to actually trade below the 20 and the 50-day moving average, and it start to see a series of lower high. And the last few days of candle is rather bearish as it shaped this bearish Marubozu candlestick on the daily time frame. Okay, so with that, very quickly, now let's us jump straight to the short-term intraday technical outlook. So the short-term in the intraday technical outlook, yesterday, it broke below this minor ascending trend line that I drew from the low of 7th of June, okay, which is that 2,308 level, broke below this level. So what we could see over here is that the first support has been met. So right now, price action very bearishly, it continues to trade below the 20 and the 50-day moving average, and so continue to evolve within this minor descending channel that has this pink channel, a minor descending channel that has taken shape since the all-time high of 20th of May, and it hasn't even hit the lower limit of this minor descending channel yet. And what you could see over here is that the RSI now try to bounce off from the oversold region. So in the short term, there could be a bit of minor rebound taking shape or snapback rally taking shape. But as long as this snapback rally didn't surpass the 20-day moving average right now, that is acting as a resistance at 2,326 level. So I do have a tighter key resistance level for today at 2,326. So as long as that potential snapback rebound didn't surpass above 2,326, we will still maintain that short-term intraday bearish bias on gold XAU / USD. Next resistance zone to watch will be at 2,280 / 2,270. A breakdown below 2,270 exposes the next support area at 2,244, which is the lower limit of that minor descending channel that is playing out right now. Only hourly close above 2,260 will kind of invalidate today's short-term intraday bearish bias to see a steeper mean reversion rebound to retest the 50-day moving average at 2,344. Above 2,344 potentially sees 2,365, which is the swing high area of 21st of June, and as well close to the lower limit of this minor ascending channel as well. So that's for gold XAU / USD. Lastly, let's us look at WTI crude oil. So no change, WTI crude oil 82.20 short-term pivotal resistance level, hit the first support level at 80.60 before shipping a bounce. All right, so right now these key levels remains unchanged. Only a breakdown below 80.70 may expose further weakness in the short-term intraday basis towards 79.45 / 78.90, which also confluence with the 20 and the 50 and the 200-day moving average. However, an hourly close above 82.20 will invalidate today's intraday bearish bias on West Texas oil to see the continuation of the recovery to expose the next near-term resistance to come in at 82.90, then thereafter followed by 84.40 next. So what's 84.40? 84.40 is the minor swing high area of 26th of June, 26th of April, and 29th of April. Okay, so that sum up today's short-term intraday outlook on the key cross-asset classes. So before we go, let's take a look at the economic calendar. What are the data to look out for today? So today will be Thursday. So what we do have over here is a rather quiet session during the European session, but we do have some key central bankers speaking during the evening time, Singapore time. So at 6 p.m., there's this RBA official, Husen, speaking. At 8:15 p.m., there's an ECB official, Alderson, speaking at 8:15 p.m. Singapore time. And thereafter, a rather quiet session during the US session. So we do have that initial weekly jobless claim data. This is for the week ending June 2020. 22nd of June, so that will be out at 8:30 p.m. Singapore time. Okay, then thereafter it will be a quiet US session. So what we do have over here is during the early Asia session tomorrow, we do have key data that could impact the Nikkei 225 and as well as the dollar yen, which is the Tokyo core CPI data. The focus will be on the ex-food and energy that has slipped below 2%. So in the previous month of May. So that is at 7:30 a.m. Singapore time in June, for the month of June. So that's the Tokyo core CPI data. Then thereafter, right, we do have another data to look out for, right? It will be the US presidential election debate. So that is the first debate between Trump and Biden that will be held at 9 a.m. Singapore time tomorrow. So if you Google over here, okay, let me share your, where is it? Okay, you just Google US presidential debate. Okay, sorry, my screen is hanging. Okay, seems to be a, oh gosh, I don't know what's going on. Okay, let me expand my screen. Okay, just what time is Trump versus Biden debate? So it will be hosted by CNN. So it's 27th on June, but that's 9 p.m. Eastern time. So 9 p.m. US time, 12 hours later than us. So that is actually 9 a.m. Singapore time tomorrow. All right. So bear in mind, this is another key event to look out for as well, especially they will actually debate on their potential trade tariff policy. If they were to debate tomorrow, something very interesting to see that could actually potentially impact the market as well as the debate goes on. So that's 9 a.m. Singapore time tomorrow. All right, so with that, this Kelvin here signing off for today, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.